Hi everyone, welcome to our How Loss History Affect Underwriting webinar. I will be your presenter, Michelle Belden here at CID Insurance. I am the nonprofit and commercial new business underwriter. Also on the call with us today is Jacob Cole, our marketing coordinator. So he'll be there to facilitate the chat. So if you guys have any questions, feel free to drop those in there while we're going throughout the presentation. And he'll let me know when we have some questions and I can go over those. So our webinar objectives today, we're going to go over defining what loss runs are, the differences between loss runs and no known loss letters, and types of losses. Really understanding the process in which me as an underwriter, when I'm reviewing your submissions with loss history, how the loss history affects where we can take a risk. Key components of loss runs, because not all loss runs are made equal. So we'll go over various examples of loss runs throughout the presentation, and I will have some spots highlighted to go over some key pieces of information we're looking for. And then we're going to also talk about spotting some red flags that we are looking for when we're reviewing the loss history, because there are things that could, cause a risk to be declined because of something we see on the loss history. So we'll go over a few examples of that as well. And then how to communicate loss details is extremely important. We're trying to sell the risk to the carriers on behalf of you and your client. So the more information we can get, the better. And then lastly, how to be proactive to prevent losses. So while I will say the main focus of this webinar from a loss history perspective is going to be more towards P&C side of things, but not to say that this can't cross the board if you were trying to write a work comp risk or a professional risk, things like that. But I will say this is going to be more focused on things that are driven from a general liability losses or property related losses. And I do just want to say again at the top, I am not a claims adjuster. So if you have any specific questions that are like really specific to a specific type of claim, it's not something I'm going to be able to answer. So this is more just to go over like the broad strokes of like what we're looking at when I'm underwriting a new business or a remarket risk for you, and how we can try to present it to the carrier to get you guys the best quote possible. So some definitions to go over. Everybody should be pretty familiar with loss runs. It is a document that's provided by the carrier in which an insured has a policy with. So it can show you their loss history over, depending on how long they've been there. Generally, we're looking for the last 3 to 5 years. That varies by carrier. So that will give us, the information. The named insured will be on there. Their policy dates may or may not be on there. The type of coverage, if they've had any claims, the type of claim, what's been paid out. So all that good information is provided on loss runs. And it's really important, especially these days with quoting, that we need loss runs. A no known loss letter is different than a loss run. So we can get that when, it's a statement when either an insured is just starting out, maybe they've worked in an industry before, and now they've started their own new venture. And so they have experience, but they've never had their own coverage before. So we could get a no known loss letter in that instance. We could also get it if coverage has lapsed. So, maybe somebody had coverage for like 3 or 4 years, and then something happened and they had a lapse in coverage for like 4 or 5 months. Maybe it was because of non-payment, or they got non-renewed and couldn't find a replacement market, and then they're looking to get coverage going again. So we would want to be confirming during that period where they didn't have any coverage that there aren't any known losses. So we can give that information to the carrier as well. And then just some general information about types of losses. So your general loss, your run-of-the-mill everyday type of losses, slip and falls, a vehicle potentially crashing into a building, there being water damage because of a leaking pipe. So just an unfortunate event that happens. It's not expected, obviously. And then you've got your like shock losses. Generally, it's a catastrophic event. And it'd be more of, like they, like say a building next door to a building caught fire and then their building caught fire. The building of our insured who had the shock loss and not the one that caused the fire, their building was damaged. So it was kind of a shock for them because it wasn't expected. It was a catastrophic event. It wasn't something that was, not that any loss is planned, but that it truly affected them, and it wasn't necessarily their fault in anything that would have pertained to them causing a loss. All right, so the role loss history plays in underwriting. It is a carrier requirement. It is extremely important these days. If we submit business without loss runs, most of our carriers will come back and ask us for the loss runs. It's getting harder and harder these days just because of the market to submit something without loss runs. If you let me know, hey, like when you send in your submission, I've requested the loss runs, I just haven't gotten them yet because I'm either not the incumbent agent or it's not the carrier that you're currently with or the insured hasn't already gotten a copy of them. That's totally fine if you can just communicate that information. And two, people tend to confirm like, hey, like they've told me there's been no losses. I will still submit the risk to the carrier as long as we have all the other information we need and let them know that the loss runs are being worked on, and we'll get them over to them as soon as possible. So it's getting harder these days to kind of to quote without the loss runs. If there has been any losses in the last 3 to 5 years, that will be a requirement for us regardless. We will need those loss runs to be able to submit to the carrier because we only have so much authority in-house with certain markets on how high a loss history can go. So like I said, it's really important that we're getting the loss runs. And then we're gonna what information they provide to us. So like I said earlier, not all loss runs are made equal. So not everything, all the information that you would like to be on there. It'd be nice if they were universal across the board with all the carriers, but that would be too easy. So it does provide us important information to be able to sell the risk to our markets. If they've had losses, it's really important because it's information we need to review and to be able to sell a story to get another carrier to want to get on the risk. And then by providing the appropriate loss history information, it helps us be able to get you guys timely and bindable quotes. So depending on what their losses look like, if it was like one just, kind of random loss and it was small, or one really large loss, or they've had multiple of the same losses, like we need all of that information to be able to sell this to them, to explain to carriers, what we're looking for and like why do they want to take on the risk? Why do they want to be potentially liable and opened up to potentially having claims if they see a pattern of certain types of claims? So it's really important that all that information is provided because it does affect us being able to underwrite and provide you guys a quote. All right, so we're going to get into some examples with these components. So the loss runs valuation date is an extremely important one that we run into issues with. And so I will have an example of that because we're constantly having to explain that to people. So I want to make sure we understand that. Another thing that's important on loss runs is obviously the named insured. I've gotten loss runs that have no named insured on them before. So how can I say that they go to that policy if we don't have anything to tie it to? Having the named insured is on there. Not all loss runs include an insured address. Sometimes they do. And if they do, sometimes it's a mailing address. Sometimes it's the physical address. Sometimes it's both, or it's not on there at all. The policy dates, that's extremely important. We need to know when and for how long they've had coverage for. So that information will be on your loss runs. And then lines of coverage, that's not always on loss runs, but it is extremely helpful if it isn't, or if they had to like split coverages up so that say maybe they had a GL policy with one carrier and a property policy with another carrier. When you're submitting over your loss runs, if you could label them so we know like which goes with which policy if that information is not provided somewhere else in the submission. So we're lining up and we know what loss runs go with what line of coverage. That just helps us as well. And then other things would be loss information. So if they have had losses, you're going to generally see the payouts, if there's a reserve, if there's been recoveries, if the claim's open. Other things that could be on there would potentially be like the claims adjuster. So just, the information that actually gives us details about what occurred for the loss. So the first example we're going to go through is evaluation date example. So on the left-hand side, we have not currently valued loss runs, and then on the right side, we have currently valued loss runs. So with most of our markets, we're looking for loss runs to be valid within 60 days of the effective date. So that could be 60 days prior or 60 days after if it's a couple days because they needed some extra time. So in this example, we can see the ones on the left so we'll just use this as an example. I got this submission for an apartment, and when I got the submission, the loss runs were valued in September 19th, 2024. But we're looking to quote this in July of 2025. So with that being the case, those loss runs are almost a year old. So while I can use those to start to submit the business to show the carrier, we do need currently valued ones at time of bind, especially because, it has GL on there. GL is on a occurrence basis, not a claims made basis. So, they might have a loss that gets turned in 2025 that technically happened back on the 23 to 25 or 23 to 24 policy term. So that's why we're looking for currently valued loss runs. I would say this is one of the biggest culprits we get when we're binding coverage. So any quotes that we send out in our office will always list on there if currently valued loss runs are required. A lot of times I'll get back like, oh, I already sent you the loss runs. And I'm like, yeah, I got your loss runs, but they were valued more than 60 days ago, or, some cases are over a year or 2 years old. So we're always looking for currently valued loss runs. So we will always list that information on our quotes when we send them out if we're able to offer terms, if we need currently valued loss runs. Like I said, most carriers are 60-day evaluation. Some are 30, some are 45, some are 90. It really just depends. But for us, on average, we're looking for loss runs to be valued within 60 days of the effective date. All right, and then I'm going to do an example of a named insured. So for this example, we are going to talk about how this named insured went from on the 2020 to 2021 policy term went from John Smith, and then the 21 to 22 policy term went to 123 Main Street LLC. So when we see different named insureds on the loss runs, that kind of makes us question things like, is this for the right account? Why did they have a name change or something? So for this example, I'm just saying this person owned a building and originally purchased it in their individual name and then decided, no, I'm going to put this in an LLC. So then they switched names. So the policy wasn't necessarily rewritten. They just updated the named insured. So with changing the named insured, it does vary by carrier. They may require a rewrite depending on if ownership has changed with the names, and if ownership hasn't, they might just be able to update the named insured. So if there are variations of the named insured when you're sending over loss runs, if they've had multiple policies, or the carrier provides the named insured on each year, just explaining that information to us as to why the name changed is extremely important, just so we can provide that information to our carriers as well. What I'm looking at is the same thing that my carriers are going to ask me the question on. So if we can have that information, it's really important. I will say for anything that's an LLC, a corporation, even nonprofit organizations, you can always check your Secretary of State's in whatever state you're in to confirm the legal name. Named insured is an extremely important thing. You want to make sure you have that right on your policy. So we are constantly checking that ourselves. So you might see us have like tweaked names, named insureds. It's because we want it to be whatever they have filed with the state. Obviously, if it's an individual name, a partnership, and those aren't things you're going to be able to check on the Secretary of State because they're not filed. But we want consistency. So we want to make sure we are listing the right names on the policy. All right. So some other examples I want to talk about is status on losses and payouts and coverage types. So in this example, on the top portion, you can see that there was 2 losses. Both were closed with pay. So, that's helpful too to know if they're closed with pay, closed without pay, if they're open, where we're at with the claim, because that will affect, market availability. Some carriers, don't want to take anything that has an open loss. Some will be like, okay, close no pay, no problem. Almost to them, like if it's like 1 or 2 of them, it's like, okay, they never had a loss realistically, because something caused it to not be able to be paid out. Maybe it was less than the deductible, or it was like somebody decided to file a claim that didn't really apply, so it was just closed out. And then other ones with, if it's closed with pay, then obviously we've gone through the whole claims process. So claim was filed, a claims adjuster was assigned, and they went through all of their steps to adjust the claim, and then a payout was made. And then once the payout was made and everything's been signed off on, it's going to be closed out. So that's an important thing. And then, like I said, with the closed no pay, if it's less than the deductible, could have been accidentally filed, or coverage isn't applicable. Like I've seen sometimes people will, let's just say they had split their coverages between, they had a GL policy and a property policy, and they filed a GL loss on the property policy, and it was intended to go on the GL policy. Then that would be a closed no pay if they went through the process of opening up a claim because it doesn't apply to that policy. So that could be an example of why you would have a closed no pay. And then an open loss is still going through the claims process. So it's been filed, an adjuster has been assigned. Generally, a reserve is set depending on the type of loss, or they've started to, if it's property related, potentially have started to do some repairs. So they've already gotten estimates and bids from contractors to start making repairs. So they've been paying out as certain repairs have been getting done. So they haven't gone through the full claims process yet, and everything's not been updated and repaired as needed, or paid out if it's a open loss that's GL related that could potentially be, in the court system because there's a lawsuit or something. So, open losses can be open for some time, depending on the type of loss and what is pertaining to like holding it up. So generally, if you see one that has a reserve and a high reserve set, I would say generally it's probably going to be stretched out for a little bit because they're working through everything. Okay. The next example I want to go over is a recovery example. So if a carrier is able to subrogate against the another person who caused the loss. So for this example, I'm going to say that a vehicle ran into a building, damaging it. And so then the insured, who owns the building, turned in a claim because their building was damaged. So then the carrier chooses to try to go after the person who ran into the building after either their auto policy to try to recover some money. So they're not paying out the full loss. I mean, if you can, carriers are always going to try to subrogate because they don't want to pay out everything that the total of the loss. So that's really helping them to not have to pay out as much. So in this example, they were able to recover $1,000. So then while the loss is showing you the total paid out was just under 3,000, the carrier for the insured that owned the building realistically only paid out about 1,800. So that does help to be able to, recuperate where they can. That is the goal. Not all losses can be segregated against, so really depends on the loss and what occurred for a claims adjuster to be able to try to go after, potentially the person or entity or whomever caused the damage. So like I said, not all losses can be segregated, but if a carrier can, they're definitely going to try to segregate so they don't have to pay out as much. All right, so spotting some red flags. So for us, what we're looking for is if there's been lapses in coverage. So if there has been, what caused that lapse in coverage? Was it non-payment? Sometimes insureds end up in the hospital and they miss making a payment, so their policy cancels. They've been non-renewed and they couldn't find replacement coverage in time. So just why is there a lapse in coverage? It's really important information for us to know to be able to present the risk to a carrier. We have, there are certain carriers out there who won't accept a risk if there's been a lapse in coverage. So knowing that information helps us so we know what markets we can take a risk to. Um, and then if they're shopping midterm, why are they shopping midterm? Is it because they're being canceled? Was there something that maybe they had a loss control survey and information was found and so the carrier's requiring them to get off the risk and so it's being midterm canceled? Are they just looking for a better rate? If you are looking for a better rate and you're shopping midterm, it's really helpful if you can provide not only the loss history, but provide us with a target premium so that we can see if we have any markets that could potentially be better. Shopping midterm, it's really like the more information, and it's kind of goes across the board that you can provide, the better. Um, Another thing that we'd be looking at is loss frequency. So if they've had multiple of similar type of losses in a 3 to 5 year period of time, do they keep having water losses? Do they, maybe they have like one that's 2,500 and then another one that's 3,500 and then one that's 10,000 and they just keep repeating in themselves in a short period of time. Why? Why aren't they doing anything to try to fix that from occurring anymore? So that's something that our markets are taking in consideration is how often they're happening. Loss severity, have they had a single really, really large loss or have they had multiple losses that add up? Again, all this stuff we'll go through an example with. So if you have any questions, once we get through those, let me know. And then are the same types of loss continually happening? That's something, that carriers are going to be like, well, why do I want to be on this risk if they keep having water losses, or there's an area obviously somewhere if somebody keeps having trip and fall related claims. So what is causing that continually happen, and why isn't the insured doing anything to try to prevent that? So this is all information that the carriers would be like, well, why would I want to be on this risk if those things are in effect? So for our policy dates example, for this one, I will show, so on the bottom portion of the 29 to 2015 term, you can see that coverage was from 3/22/2019 to 3/22/2025. But then they didn't replace coverage and on the 25 to 26 policy term until July 23rd, 2025. So they did have that gap in coverage from March to July. So in this instance, we'd want an explanation as to why there was a lapse in coverage. And if we were to bind coverage, we would be needing a no known loss letter for that lapse before we were able to put coverage in place. So again, these are things that we're looking at on the loss runs. If we see, we're going to question it, and we're going to want to get more details about it if those aren't already provided, because it helps us sell the risk to our markets and be able to help you place coverage for them. So like I mentioned earlier, lapsed coverage can affect market availability. So we're always wanting to show, if we can, continuous policy coverage for them. So if they have it, that's great. And the more loss history when it's 3 to 5 years that we can provide, the better. So it's just really important to give us that explanation if there's anything that looks askew on the loss run, like, okay, why is there a lapse, or why did the name change? All those examples I was speaking of earlier. For this one, for the loss frequency and severity examples, so on the top one, we can see that they've had a lot of losses in a short period of time. From 2020 to 2023, you're looking at like 8 losses with the payout of over $250,000. So it seems like they kept having certain types of losses, even though a portion of those were closed no pay. So depending on that, could also affect you, even if they're closed no pay, because like, why do losses keep getting turned in on a policy if they're not paying out? A carrier could question that. But then the top portion where you can see that they've had a few, they had 3 commercial property related losses in basically a year's period of time, and how much it's paying out, like, to a carrier, that could be a red flag, because what is happening, what are those types of losses? So if they were all continually to be like water damage, or um, how that affects it. So that's important to know the types of losses, what they were, and providing that information to us and explaining, like, okay, hey, yeah, you see here that they had a lot of losses for this period of time, but they've turned things around because they've, you know, redid the plumbing if it was water related potentially, or they had people continually running into their building just because of the street they were on, and it was like a known issue, so they put poles out in front. So the things that they can do to try to limit and bring down the frequency of losses is something a carrier is going to want to see. In our bottom example, we can see that this claim is extremely large. It's over $2.6 million that they have in this loss, because there was an extremely large fire that damaged a good portion of the building. So in this example, they've only had one loss, but of how big it is, that will affect market availability. Some people aren't going to want to touch that with a 10-foot pole because of the size of the loss, even though it's only been their one and only loss in, however long they've been in business or owned the building. But because of the size of it makes it harder for a carrier to be able to get on the risk, especially with it still being open too. So you're just adding another layer when a loss is not only large, but then also still open. So again, all these things are important things to provide as much detail as possible for us, so we can send that to our markets to be able to explain it to them as well. And 2, even larger losses, even, once we get past that 5-year mark, sometimes they'll still follow insureds around. If you continually to submit the same risk to the same markets every year to try to remarket it, to try to find it a new home, that loss might follow them a little bit longer than it just falling off if it maybe was a little bit smaller of a loss, because it would be we've hit that 5-year mark, and then that carrier is no longer looking at that because they're looking at the past 5 years instead of the past 7 years. So larger losses can definitely follow the insureds around a bit more, especially if there's like they've been open for a period of time. So that's information that could potentially be asked. You might be submitting a risk who had a really large loss, maybe let's say 6 or 7 years ago, but a carrier had gotten that submission before, and they would be like, okay, well, they have had this loss, hasn't been closed out yet. Like, what was the final payout? They may ask those questions and still take that information, even though technically the loss has fallen off because you're at the 5-year mark. They still might be looking at that information because it was such a large loss that it could affect them still being able to offer them terms or not. Okay, so what to ask about losses? And important things to ask, like I've been saying, is what happened. So on loss runs, you don't always get a lot of detail. Sometimes you'll just see like water damage or like property, and I'm like, or building, and that doesn't really tell us anything. So giving an explanation of what occurred. Did a pipe burst? Did somebody run into the building? Was there a fire? Um, so anything that all the details you can provide about how the loss occurred. I know some losses, they kind of just happen and you don't really know. That's fine. But if you like whatever details you have that are able to be provided, it's really important to provide that because, like I said, we have to make a story to be able to submit to our markets to get them to want to buy into the risk and be able to offer your insured terms. Wanting to know if the loss is open or closed. If it's still open, we were wanting to know, have they begun repairs, where they are in the claims process. Is it one that's maybe potentially going to be open for a little bit? Because, like I said, they could potentially be in going through the court system because there's a lawsuit. If it's closed, we're wanting to confirm that, any damages have been repaired, because that's really important to be able to correct the spot that caused the loss to occur. So if it was a trip and fall loss, say it was a piece of uneven concrete, we would want to make sure that that concrete has been, repaired, sanded down, or repoured just so it's flat and even, and that loss doesn't necessarily occur again. It's not to say that it won't, but it's the potential to try to reduce the loss. So any information you can provide on that is extremely helpful. Some carriers will come back and ask to confirm that if there was specific damages that are properly, that the repairs were done by a licensed contractor. So that's definitely something to keep in mind. And generally, most repairs are done by a licensed contractor when there's a claim involved, because the claim team and adjuster, they're going to be looking for bids and from actual contractors to be able to get the work done. So generally speaking, most repairs would be done by a licensed contractor, but that's something else too that, we'll get questions about from some of our markets just to confirm that information. And then what instances are they doing to try to prevent this from occurring again? So like I said, with my slip and fall or trip and fall example, that they, resurface the concrete to make it even. If it was water related, did they go in and repipe the building, or did they implement having a plumber come out, once a year or biannually to check everything, make sure everything's in working order. So what actions can they take? So if we can show that an insured is taking the appropriate steps to try to prevent these from occurring again, that helps as well, because, carriers are going to want to see that they're being proactive about it, and not just hoping something doesn't happen again. Some things you can't really, take preventative measures for. And that's the nature of a loss. Anything can occur that could cause a loss. So if there is something that can be done, we would like to know what they've done. If not, we get it. There's certain things that just like it happens and it was a fluke, or it was that, that shock type of thing. So it's just like, okay, there's not much we can do other than repair it and move forward. Okay, and then my next example, which will be our last example, will be on an open loss. So in this instance, you can see that, like I was mentioning on the previous slide, when we're wanting those, knowing if it's open or not, where they are in the claims process. So sometimes they've already made some payouts because work has begun. Other times they have, um, like I said, if it's a lawsuit, they could potentially be waiting for, a court date to be set, or they're waiting for arbitration. So it just the information we can get about losses is really important. If there is a reserve set on an open loss, generally we'll ask if there's any known instance where the reserve could potentially increase. Sometimes they'll set the reserve kind of high, and then once the loss finally closes out and pays out, it could pay out much less than what the reserve was originally set at. So we're just wanting to know this information. If there's a potential of anticipated close date, that's, can't always be given, but sometimes people are, almost to the end of their claim and their claims process. So it's like, yeah, they're just wrapping up. They just need to sign off on their final payout, and then the claim will be closed. So if you have that information, again, really at the end of the day, it's the more information you can provide when a loss has occurred, the better. All right, so how to be proactive with losses. So again, like I mentioned at the beginning, this would probably pertain more to property and casualty related risks. So if somebody owns a building or is a retail shop owner or something like that, do regular walkthroughs of the property. Look to see if there's uneven concrete or if there's unevenness in their parking lot. If are there areas, items that are obstructing, walking past, things to do. So regularly walk through their property to make sure things are all in good, working order, that there's a clear path, that there's not obstructions that could potentially cause a loss. If somebody owns a building, or even as a tenant, is required to maintain their own system components, to regularly check those. So, maybe have a plumber come out, once a year, just to make sure everything's in good working order and there's no issues that they could potentially detect. Or if, and have your HVAC system regularly serviced. If there's sprinklers, fire extinguishers, smoke detectors, making sure all those components are up to date. So that would be important to the life safety. So making sure that people are getting their fire extinguisher serviced every year, that there's smoke detectors and that they're actually working. If there's a sprinkler system, having it tested per the, regulatory requirements for that. So just anything you can do to be proactive to try to limit these risks. At the end of the day, we can't prevent everything, but it is important to make sure that those things are regularly checked. If there is a central station burglar alarm present, making sure that's armed every day in the event that there is potentially a break-in, and there, if there's a theft claim, making sure that that's actually, is operational. So you're just wanting to make sure things are, up to date, and just to try to be as proactive as possible to try to limit, losses from occurring.
Hey, Michelle, we do have one question that came in. Someone asked, do we have to request an inspection to the property?
No. So it depends on the type of risk, and what it is. And so what goes into us being required to request an inspection, it generally varies by carrier and class, and if the limits that they needed. So it's not something you as the agent would need to do. We'll do it on our side, or the carrier will do it, depending on who's responsible, either the carrier or us, for requesting the inspection. So you guys don't have to worry about doing that. But from you having to request one, or having your insured request one. Though, some insureds do have their own third party come out just to see, give them a rundown of things to see. I've known people who've done that before, where they just, want to get somebody else there, get a third set of eyes out there that can, give them some things that would be potential hazards or not, whatnot. But for you as an agent, no, you don't have to request anything ahead of time. We will do that as required by our carriers. And then anything, if there is loss control related items, we will send those out to you, so that we can get that corrected so the carrier can remain on the risk. And again, the point of the loss control is to help to try to prevent the insured from having losses. So yeah, we will
Perfect.
we will be the ones responsible for it.
Someone else kind of on that same thread asked, do you have a list to give the clients to be proactive about?
We do have a couple like loss control little check sheets together. We do have those on our website. We have some for specific classes and then some in general. So yes, we do have that information available on our website. And if there's something that you're not seeing on those lists and you're wanting to know if it's something that should be checked, feel free to reach out, and we can definitely discuss that further if there is a specific item. But generally, things that I was mentioning that are regular items that would, be on a loss control survey that we would be looking to confirm, especially from to help prevent certain types of losses, was making sure they have fire extinguishers, if they having smoke detectors, if their sprinkler system, making sure those are up to date, confirming if they have an alarm. Other items, again, like I said, doing walkthroughs through the property to see if there's any potential spots for a trip and fall. Are there oil stains or like potholes in the parking lot, having those all fixed? All those things are, again, things that we would be looking for on an inspection. And if those came back, would be required to have those fixed so that the carrier can remain on the risk.
Perfect. And I did drop the link to our marketing library where those inspection and loss control kind of checklists live. We had another question asking if this was being recorded. Yes, it is being recorded. You'll receive a copy and a link to the recording. And then one other question for you, Michelle. Broker said, I have a commercial building where the neighbor building caught on fire and spread to my client's building, causing damage to the roof. Will this affect my client's loss history if we put the claim in, or should we wait for the neighboring building's insurance to cover losses?
I mean, it could potentially, it's not something I can speak to fully, but yes, there's a potential that could happen. I mean, sometimes it's better to, at least for the insured's property, that was damaged, not as a result of them having their fire, but the neighboring, for them to turn in the claim, on their policy. So at least their carrier is aware of it. And, providing that information again, when you're submitting a claim, that it didn't occur, because then generally speaking, it would kind of go to potentially wanting to subrogate against the other carrier's policy. So, I mean, a loss would likely end up being opened on the insured's policy who was damaged as a result of the neighboring building catching fire. So it's not something I can fully speak to, but it would likely be something that would still end up with a claim on the insurance policy, but hopefully it could be subrogated against and they don't necessarily have to pay anything out, but that would come down to the carriers and how they adjust the claim. So it's not something I can speak to fully, but yeah, I mean, there's definitely a potential that there could be an effect on it. But again, like for that type of loss, it's not necessarily, it wasn't the insured's fault, your insured's fault. So, as long as we can, again, provide that story at the end of the day and be able to relay it, that information, then generally speaking, it makes it easier if in the event the risk has to be remarketed for any reason. So it wasn't their fault and they are trying to subrogate against the other people to pay for their damages. So all that information is extremely important.
Okay, yeah, we're getting into the nitty-gritty here. They said, following up on that they have not been cooperating. I'm assuming they're referring to the neighbors policy. They said my client's deciding to get legal involved or file a claim on his policy. How does the deductible come into play?
That's not something I can really speak to, because yeah, like Jacob said, we are kind of getting into the nitty gritty, and if we're not the ones on the risk, and again, I'm not a claims adjuster, so yes, I mean they could definitely follow suit against the building owner, the other building owner, but yeah, that's kind of something that they would have to do and seek out their own legal counsel on how they would want to go about that, or talk to their current carrier and see how that carrier wants to go about it to try to um, speak with that other insurance company to try to work things out.
Okay, that is all the questions that came in for now.
Okay. Well, I just want to highlight some of the products that I write here. So again, I do commercial and nonprofits. My main classes will be apartments, commercial buildings, community associations. And then I have some other, and then nonprofits, and then some other, Main Street type of risks that I can do for you. So just in case you're not familiar with me and what I do here, this is my top products and other classes that I write. All right. If there aren't any other questions, I want to thank everybody for joining us today. If you haven't been to our website, check it out at cidinsurance.com. You'll find our applications. You can find marketing pieces, what are all of our other webinars. It's a great resource. We have a lot of tools and things on there for our retail agents. So we think we've done a pretty good job with it, that people like it to be able to find things. If there's something on there that you're not can't find or you have a question about, feel free to reach out. You can submit your submissions to submissions@cidinsurance.com. Our submissions team will get them logged and assigned to the appropriate underwriter. If you're not sure, you're welcome to just send it over there and we'll get it logged, and we'll let you know if it's something we can help you with or not. But we really appreciate everybody joining us today, and look forward to getting submissions from you, or any questions you have, feel free to reach out. If you have any more questions and you post them in the chat, we'll make sure we get those answered to you via email as well if there's anything else.
Perfect. Thank you, Michelle. Thank you, everyone.
Thank
Bye-bye.
you. Bye.